Hello. So our next module is sources of financing. Let's discuss. So, introduction part of sources of financing. Let's begin. So the financial needs of a business are of a peculiar in nature. The type of amount of funds required usually differs from one business to another business. For example, if the size of business is large, the amount of funds will required also be large. Likewise, the financial requirements are more in manufacturing business as compared to trading business. So based on the period for which the funds are required, the business finance is classified into three categories. Okay, so these three categories are short term, which are generally less than a year, medium term, which are 1 year to 5 year, and long term, that is more than 5 years. Okay, so coming to sources of financing. So basically there are five sources of financing. Main, we can say main sources of financing are five. The first one is shares. So, what is shares? The capital of a company is divided into different unit called shares. So, generally, a share is the movable property of a shareholder, and he has a liberty to transfer his share in the manner prescribed by the article of a company. Okay. So, coming further, shares are divided into two categories. The first one is equity shares, and second is preference share. So, in equity shares are earlier known as ordinary share or common share. Okay, equity shareholder are the real owner of the company as they have the voting rights and enjoy decision making authority on important matters related to the company. Okay, the shareholder return is in the form of dividend, which is dependent on the profit of the company and capital gain or loss at the time of their sale. They enjoy also higher return if the company perform well, and may not get any dividend at all if the company does not do well, or when the board of director do not recommend any dividend for payment. Okay, therefore this issues, equity shares are also known as variable income security. So features of equity shares. The first feature is on capital. So equity share capital is on capital because it is the money of the shareholder who are actually the owners of the company. Okay. Second is fixed value or nominal value. Every share has fixed value or nominal values. For example, the price of a share is 10, maybe 1000, maybe 20, 30, etc. The third one is attached right. A share gives to owner the right to receive dividend, the right to vote, the right to attend meetings, the right to inspect the books of accounts, etc. Uh, Fourth, transfer of shares. Equity shares are easily transferable. That if a person buys share of a particular company and he does not want them, he can sell them to anyone, therefore transferring the shares in the name of that person. Okay, and the last is irredeemable. Equity shares are always irredeemable. This means equity capital is not returnable during the lifetime of a company. Okay. Next, the preference share. What is preference share? So basically, preference share represent a hybrid form of financing. It means it holds some characteristics of equity and some of debentures. So preference capital is similar to debenture in several ways. Like the dividend rate on preference share capital is usually fixed. The claim of preference shareholder is prior to the claim of equity shareholder, and preference shareholder do not normally enjoy voting right. Right. Okay. Sorry. So the features of preference share. The features convertibility. It means preference share may sometimes be convertible into equity shares. The holder of convertible preference share enjoy the option of converting preference share into equity shares at a ratio during a specified period of time. The second is redeemability. Preference share may be perpetual or redeemable. It means a perpetual preference share has no maturity period, whereas a redeemable preference share has a limited life after which it is supposed to be retired. So most preference share issues are redeemable. Okay, and the last one is voting power. As we know, a preference share holder, however, is entitled to vote on every resolution placed in company. Next, debentures. Next, the second is debentures. So what is debentures? So basically debentures are a type of loan. Okay, so as per definition, a debenture is an instrument executed by the company under its common seal acknowledging indebtedness to some person or persons to secure the sum advanced. It is thus a security issued by a company against the debt. Okay, so features of debenture. The first is fixed interest rate. Debenture holders are creditor of the company. They are entitled to periodic payment of interest at a fixed rate. Second, maturity. Debentures are repayable after a fixed period of time, say 5 years or 7 years as per agreed terms. Third, no voting rights. Debenture holders do not carry voting rights. Fourth one is secured assets. Uh, Secured assets. Ordinary debenture are secured in case the company fails to pay interest on debentures or repay the principal amount. The debentures holder can recover it from the sale of the asset of the company. Third is a term loan. So what is term loan? A term loan, also referred as term finance, represent a source of debt finance which is generally repayable in more than 1 year but less than 10 years. Okay, several institutions in India like Commercial Bank, Life Insurance Corporation, IFC, Indian Industrial Finance Corporation of India, State Financial Corporation, etc., provides short-term, medium-term, and long-term loans. This source of finance is more suitable to meet the medium-term demand of working capital, and interest rate charged on such loans at a fixed rate, and the amount of the loan is to repaid by way of installment in a number of years. Okay, so features of term loan. The first is security. The term loan typically represents secure borrowing. So usually assets which are financed with the proceed of the term loan provide the prime security. Second, interest payment and principal payment. The interest on term loan is a definite obligation that is payable irrespective of the financial situation of the firm. To the general category of borrowers, financial institutions charge an interest rate that is related to the credit risk of the proposal, subject usually to a certain floor rate. Okay, and the last is restrictive covenants. In order to protect their interest, financial institutions generally impose restrictive conditions on the borrower. Now, coming to lease financing, sorry, it is not highlighted. The fourth one is lease financing. So, lease financing is basically a contractual agreement or transaction. It is one of the best alternative to start straight up purchasing if someone are seeking the mean to obtain necessary business equipment and supplies that have the possible to endanger the monetary flow and stockpile. It means here lease financing is a transaction or contractual agreement in which a party owning an asset provide the asset for use to another over a certain period of time for consideration in form of periodic payment with or without further payment. So at the end of the period of contract, the asset revert back to the lessor unless there is a supervision for the renewal of contract. Okay, so features of lease financing. First one is transfer of ownership. The lease agreement do not provide for transfer of ownership to the lease as such transactions are classified as hire purchase from the tax angle. The second is specified purpose and time. The goods are delivered to the lessee for a specified purpose and time. The lessee should return exactly the same goods after the lease period. And the last is payment of sum in installment. The lease rentals are payable generally in equated level monthly installment at the beginning of every month. So, last one is venture capital investing. So what is venture capital investing? This is very modern term. Like the term venture capital refers to an equity or equity related investment in a growth oriented or small medium business to enable the investor to accomplish corporate objective. Okay, so according to a narrow sense, the capital which is available for financing the new business ventures is called venture capital. Generally it involves lending finance to the growing companies. Okay, so the term venture capital comprises of two words, that is venture and capital. The term venture literally means a course or proceeding, the outcome of which is uncertain but which is attended by the risk of danger of loss. On the other hand, the term capital refers to the resources to the start to the enterprise. Okay, so features of venture capital. First one is new venture. Venture capital generally investment made in new enterprises that use new technology to produce new products in expectation of high gains or sometimes spectacular returns. Second is continuous involvement. Venture capitalists continuously involve themselves in with the client's investment either by providing loans or managerial skill or any other supports. So that is venture capital. So today we discussed already the sources of finance. Thank you.